This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performance does not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk, and there's always the potential for loss. Your trading results may vary. No representations are being made that any software or training will guarantee profits or not result in losses from trading. This is the JDfn Forex Report.
Good afternoon, traders. I'm Scott Norris here with your Forex Report. We are wrapping up the week on Friday, August 15th, 2008. Well, after seeing a rather volatile Sunday open, many majors fell into a quiet lull in the first few days of trading. Only in the last 24 hours have we really seen the greenback awaken from its nap to extend its 4-week rally. Just before noon yesterday, the dollar pushed higher for a nice daily close and continued to slowly climb this morning. Further drops in oil and gold prices only added fuel to the fire in currencies. Data this week from the U.S. continued to point toward a bumpy road ahead, but that isn't keeping traders away from the buck. Yesterday's CPI figures showed another jump in consumer prices, while weekly jobless claims hung on at 450,000. Today we saw just a tiny push above zero in the Empire Manufacturing Index, followed by weaker than expected tick in consumer confidence reports. While this doesn't sound very promising, we must keep in mind just how quickly things are changing abroad. From a technical standpoint, the dollar still looks like a runaway train with no end in sight. Of course, logic tells us that all trends eventually run out of breath. The buck has got to be exhausted, as shown by the extreme levels in the stochastic and MACD indicators on daily charts. Furthermore, we are playing into major Fibonacci levels, as we noted yesterday. The good news is that we expect the dollar will continue getting stronger after a small retracement period. We certainly expect that each additional leg higher will come at a slower pace, but there are plenty of dollar short positions that will continue to be covered in coming months. This will only help the dollar bulls push the currency higher in the broad market. We would love to point out which of the dollar counterparts may be the weakest, but each of them appears incredibly vulnerable. The lone currency we expect may continue to be more resilient than the rest is the yen. This anticipation is based on the risk appetite fading as global growth slows further. Now to the big picture. Some of the most interesting points of the big picture have already been covered. We spoke of Fibonacci retracement and extension levels that were drawn out on weekly and daily charts. Some of the Fibo levels we are watching have been measured using trends that are some 3 years old. These are the resistance levels currently challenging the greenback's rally, and the reason we believe a small pullback may be needed before the U.S. currency can push on to much greater levels than we see today. The economic outlook both in the U.S. and abroad is gloomy. The U.S. has at least technically averted a recession so far by keeping rates low and essentially inflating our way out of trouble. Meanwhile, other central banks like the ECB are keeping rates high and allowing growth to turn negative for the greater good of protecting sharp price increases. Regardless of which road a bank takes, consumers are going to feel pain at some point at varying degrees. Knowing this, we believe that the dollar has put a bottom in place for a good while. The next downside move in the buck should be rather shallow, and new highs could be made before the end of the year. Beyond there, while it's tough to forecast today, we could ultimately see currencies take on no major direction for many months until economies truly begin to recover from this current mess. Till next week, enjoy your weekend. Take care.